All right, so the Santa Claus rally didn't really turn out to be much of a rally. In fact, it ended up being a negative. And now we're on to the next seasonal experience, the first 5 days of January. And those haven't started out too positive either, as we've been down now the first, 2-3 days so far of the week. One more day tomorrow, Monday, and then we'll see what ends up happening there. But so far, we've been on a little bit of a decline. We're going to break that down to see how significant it is in the context of that really strong bullish move that we ended the year on. So we're going to put in is it a start of a larger move? Are there any indications of that being even a possibility? Is it more of just a buy the dip experience, or we can buy now and rally into another new high, similar to what we've seen a couple weeks ago? So I'm going to show you some examples and some precedents and some signals that are cropping up over this week that can give us an indication of what to expect over the next few weeks, and whether we should expect more of an intermediate decline or maybe this is it. And then we'll break down kind of what's causing this move, this weakness, and what we can expect potentially over the course of this month. And then our trade idea of the day is a stock that's had a nice little decline itself, and we'll talk about how to trade it, kind of like what the market's doing. So let's go ahead and get started. Today is Thursday, January the 4th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on, including our Market Outlook live video here. Come down to the bottom, there'll be a heart right there. Click on that heart, it opens up the new tab. Hit that like button right there. Same thing here, click the thumbs up icon, that opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out on these platforms to all of our followers. Likes, shares, retweets, comments, all those things go a long way. That's why we always ask for it. So thank you to those who like this day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we continued our slide, now down 4 days in a row on the S&P, but still easily above the 30-day moving average. What it did do is it brought both short-term sentiment lines down to extremely low levels. This kind of late decline at the end of the day here. We're still, 0.2% above the moving average there, so we're not negative yet. But short-term sentiment, that's the worst short-term sentiment we've had of all these little dips. That's the worst one we've had so far. That generally leads to a change in the intermediate trend, which has been bullish, dark green shading and green lines. So, we're going to most likely start a dark pink shading, and the question is, when we get the bull tag, will it be a bull tag that starts a new decline, or will it be one like this that's a buy the dip, right? Both of these were buy the dip opportunities, and so that remains to be seen, and generally has a lot to do with how big of a decline we have. By the time we got this bull tag, we were a lot further below, 0.2%. Some of these other bull tags, we weren't as far below the moving average. Here we were 0.75% below. So that can kind of give us an indication when you get the bull tag, how far below. So we'll see. Right now, I would venture to guess if we got a bull tag, it'd be like one of these. Like we'll barely be below. But if we get one of these where we're down pretty sharply, that's the ones that are more likely to continue to turn into a new bearish trend. I actually think that that's the more likely scenario. We'll see what ends up happening. You can see we do have light pink shading on the Russell now. The Russell has been down a lot more. It's been down 5 days in a row, but it's been down a lot more. Its short-term sentiment is extremely low, down to the first percentile on both of these, though we are still less than 2% above the moving average. We were 10% above it at one point, so we are extremely bullish here. So we're well off of those levels. But the intermediate line is still above the market sentiment, so we're actually still doing okay there. So let's take a look at the NASDAQ. The NASDAQ 100, you can see, now does have the bull tag. Again, very extreme short-term sentiment, both below the 5th percentile. We are below the moving average, hence the bull tag. So we have light pink shading and a yellow line. The intermediate line is well below market sentiment there. But the crossover occurred above 80, so not nearly as important. but still, it's significant, something we need to keep an eye on. So again, is this a bull tag that is a buy the dip, or is this a bull tag that starts a new intermediate run to the downside? And as of right now, you would say, well, it's only 1/3% below the moving average, so more likely it's going to be a buy the dip type signal, especially considering the strong bullish momentum we actually still have. Your Dow Jones, same thing, but it's a lot further above the moving average than all the other indexes. It's more than 2%, but it has bearish short-term sentiment, more bearish than what we've seen this entire time and all these other dips. So that tends to lead. You can see when you start to get bearish short-term sentiment, it tends to lead, if not on that particular run, the next one, right? It tends to lead to more weakness going forward. So definitely need to keep an eye on that and see. But again, my expectation, and partly because, and you'll see this tomorrow because we got one more day left in the week, but partly the reason why I consider that will be more bearish is we have a bearish crossover here on the Russell 2000 crossing below like the intermediate line, market sentiment lines. Things are turning more bearish. You can see after really taking off in the last couple of weeks, this is a bigger down week than what we normally get. Again, the crossover occurred above 80, so it's not as significant, but you can kind of get an idea that things are, after getting the cluster on the weekly chart on the NASDAQ, this is more bearish, right? This is an extreme low so far on the momentum line. Again, that doesn't necessarily mean that things are going to start to be bearish, but you can see the last time when we went a good long time with a cluster, no less, of being bullish, that first time we dipped below 5 was a time that pretty much they ended the bullish run, and it looks very similar. This week looks very similar to that week, the week of the first week in August there. Let's take a look now at the other weekly chart, and that's this. I mean, this is a pretty significant transition candle. Obviously a lower close. PPO starting to turn over a little bit, or slightly higher, not quite turning over. You can see the well below the moving average on the Hakinashi differential down here, but still, and only slightly negative, but still hasn't broken down to sharply low levels yet. The Russell 2000 has got a little bit more of a bearish candle there. Much bigger decline too. The size of the candle was much bigger on the Russell. We talked about this a few weeks ago when we had the long upper shadow and the bigger body. That combination typically means exhaustion, and again, we've had a couple of weeks here where there's your exhaustion week right there. We had a couple more weeks where we were just kind of slightly higher. The week before Christmas, or the week after Christmas, excuse me, we were kind of slightly lower, but then now you can see the result like this. That's a bearish candle. When you get a transition candle and the actual candle's bearish, it generally leads to more bearish candles coming up. So you can kind of get an idea there. From a 3 green arrow standpoint, again, we only have 3 red arrows on the Qs. That's the one where we got the bull tag. You're close on the S&P, on the Russell. You're not as close on the Dow, but momentum is significant. I mean, look, the strongest downside momentum in 3 months on the Russell, strongest downside momentum on the Qs and on the S&P. In fact, the last time we were this strong on the momentum, we were in an intermediate decline. You can see here, looking at the size of this momentum, all of these the weaker ones, we never did get the dark pink shading. But once you get to this strong in momentum and all these other instances, we had pink shading, which would mean 3 arrows for an extended period of time. So pretty likely, especially considering the volume was slightly above average here today. Looking at the 2-line version of this chart, again, we are below the 17-day moving average. MACD is easily below its moving average. The Qs have broken below the 17 and the 30 slightly. Again, the MACD and stochastics are dropping more significantly. Here's IWM, well below its 17-day moving average. Bigger gaps in between these, especially down to the 50. So bigger drop on the MACD there, and you can see its histogram also is pretty large, especially for being as bullish as we are. Here's another way of looking at that stochastics. We are now not in bullish territory on the stochastics for the first time. Now you can dip your toe like you did over here, and we bounce back up. So again, very good chance that we can get this kind of a move here. We'll see. Now again, we weren't as parabolic at that point, We got more parabolic at the end of July. I mean, we were extremely parabolic here at this point. So it's unlikely we'll get that kind of a move. But you can see it's possible. So let's keep an eye on that here tomorrow as we're just now getting into that. If you look at the NASDAQ 100, we're flirting with getting in the bearish territory. And you can see over here on that same move, that wasn't the case. So different scenario. Your Russell 2000, kind of the same thing. We are in the lower half of the chart here. Much bigger decline. Looking at some of these other oscillators, for the S&P 500, you have the DMI. Look at both those lines sitting right around 25 there. The positive is still above 25, the negative is still below, but obviously ADX is dropping hard. We are not as bullish anymore. You look at the Qs, we have the crossover now, so we've gone to pink shading on this. Your strong ADX. Your negative indicator is above 25. Your positive is not below 20 yet. So we'll keep our eyes on that. And here's IWM, kind of looking like the S&P, much bigger ADX. It got up. It actually did get above 50 on that. Looking at the RSI and the CCI, out of bullish territory, but not in bearish. Right, we're still in the upper half. We are below minus 100. So again, another buy the dip signal. For the S&P 500, same thing here. We are in the lower half on the Qs. We're well below 100, so we're below minus 150. So that kind of we don't want that buy the dip signal to be too low. And same thing, you're below minus 100, but still above 50, out of bullish territory, but not quite in bearish territory yet. Looking at the Ichimoku cloud, you actually still have a trend, right? We still have a mature trend. We haven't lost the bearish trend. So again, similar to over here, we can maintain this if we can bounce right off of this blue line and not get below it. You get below that blue line, and now you have a gap between the blue line and the cloud that tends to get filled in, right? And it's a pretty sizable gap there, so it can lead to some weakness. And obviously, we would be ending the trend if that happened. You haven't ended your trend there, even though you're slightly below the blue line. We're probably one more day away if we get another day of weakness tomorrow. And the same thing with IWM. Again, look how sizable that gap is. If we can hold it, great. We can bounce off of it and keep going. You break it, you tend to fill in the gap, right? You tend to fill in the gap once you break those blue lines. So you can kind of see where the support needs to hold here over the next few days. And again, remember, you always expect support to hold until it doesn't. Here we are right around the midpoint of the Bollinger bandwidth, so we're not in the lowest quartile. You're slightly in the lower half of the bandwidth. Your momentum your bands are still outside of the Keltner channels as you work your way down there. We are in the lower half, though not the lowest quartile yet, of a falling bandwidth. Again, green dots. We're still outside the Keltner channels there. IWM kind of looks very similar. Here we go. We are in the lowest half. It's a very, very wide bandwidth, which again opens up to more volatility. Like we can move anywhere inside this bandwidth very easily. So the bigger the bandwidth, the bigger the moves. The smaller the bandwidth, the smaller the moves, right? So it's not only a function of how volatile we have been, it's also a function of how volatile we will be going forward until we get some kind of breakout. So when you have such wide volatility, you can get really sizable moves in both directions. In this case, again, looking at how much we are outside the Keltner channels and even how wide they are, we can get a pretty sizable move to the downside and not be anything, just be noise, not necessarily be trending at all. Looking at the intraday chart, again, we didn't get a new high. We actually broke below at the end of the day. Yesterday's low point closed below yesterday's low, so slightly lower high, slightly lower low, breaking below the value area. You can see there's a very poor margin of safety, so we can drop pretty quickly because there's no support in the last 4 weeks here. That low point after next week is going to really ramp up pretty quickly. So we're going to be over a couple more days with the green line getting below 70. We're going to be very susceptible to the breakout, to a new 4-week low point forming, especially as the range, as this low point moves up and the high doesn't move. The range is going to get even tighter and tighter. It's already below 5%. It's going to get even lower and lower. So again, another way it's setting us up for a breakout to the downside. Today's volume was slightly above average. You see the range was right at the average, and that is a low average. Even with the gap, we still filled in that gap there. 84 million shares trading hands. When you look at, sorry, not that chart, this one down here, you can see the volume has been picking up, and we were above average today. And the range has been very low because of, pretty much the Christmas week and coming after. We haven't had big moves. So again, we are, typically when you're bearish, you're coming off of lows and you start to rise in the ATR over the course of the intermediate decline. We are at the lows enough that typically starts intermediate decline. So that's been a result of this parabolic move that we've been on, that we've really just started grinding to the upside. The VIX finished at its high, still below 90%, so still not a threat. We haven't been above 90% for a long time since we really broke down over here on the VIX. But you can see the VVIX is still relatively high. And the other thing too about the VIX is it hasn't closed above its 50-day average value yet. We're sitting right at it. Again, that you get a change in sentiment when you start to break above these levels, in this case the 50 and especially the 200, and you're sitting right at the average 50-day value for the VIX, right around 14. So get above that, and now you'll probably start to see higher levels of volatility all across the board, especially against like VXV, and then of course you'll probably end up getting higher VVIX levels as well. All right, now let's talk about what's driving this price action. Again, you see how bullish we've been over the past 3 months. And remember the three-headed monster, strong dollar, strong commodities, and stronger yields were very bearish for equities throughout most of 2022 and periods of 2023. So the opposite, of course, provides some risk of appetite, and equities rally. And you can see stronger bonds, so lower yields, weaker dollar, really weaker dollar over the past couple of weeks, and commodity prices also falling. So that's had its impact over the past few weeks. So let's look at just today alone. Come out here, and you can see here, it's like, okay, well, yields were really up today, 1.5%. For the most part, didn't impact equities too badly. Commodities were actually down quite a bit too, with a weaker dollar. I think that helped. But as we came off the lows in commodities, stocks came, and the dollar hit their low, stocks came off their highs and eventually ended up down as commodities. We're down too, but not down as much as they were early on in the session, down more, almost 1.25%. If I were to go back to the last 4 days, including this day here, the last day of the year, there's the weakness. You can see the strength in the dollar these past 4 days. The outperformance of commodities, yields being down, TLT being down, which means yields are up. Again, that three-headed monster kind of rearing its ugly head and putting some pressure down. Q's down 3.6% in the last 4 days. IWM down 5%. It's down more than 5% because it was down actually a fifth day. The other indexes were up that second to last day. So in fact, when you look at the Russell 2000, this kind of stands out here too in terms of my expectations of this decline. If you look at this 5-day decline that we've had, 5-day here and 5-day here, you can see we actually had a 5.25% decline. If you notice, if I were to throw on this line here, 5 minus 5.25. So you can see we typically get this bearish of a drop over 5 days at the end of these moves, right? The end of these declines. One time that we didn't was here in August, where we also got about a 5% decline, 5.25% decline in 5 days, but it was the beginning. All these others were at the end of bearish moves, at the end, all of these, at the end of these big declines. But this, like the August, is actually, we're coming off of a peak. This is 5 days off of a peak. And again, typically when you're coming off a peak, you don't get, so you come off this peak. It ended up being a pretty big decline, but we didn't start with a 5-day. The 5-day drop only was like 2.33%. And eventually you're, at the end of that one, you're only down 3.7. Over here, you had a drop of 4.25%. Not as bad. Over here, you had a drop of 4%. Again, not as bad there. And you get the idea. Over here, you had a 5% decline of about 0.5% or 2%. And those were all declines, significant declines. But like August, here we are with a pretty significant line to start the move. Again, kind of shows that maybe we're a little too frothy. I mean, shoot, we've already, in 5 days wiped out a couple of weeks worth of gains here, starting to fill in that gap on the 14th, on December 14th there. And you can see that not to the same extent on SPX. SPX we're only down less than 2%. And then if you go back to the 14th, the 13th, and the 14th, you can kind of see, we have gotten past that low of the 14th and getting into the midpoint of the 13th there. So we are starting to move, and breadth is starting to look more negative. We dropped below -30. We haven't broke that -35 mark yet, but this is 2 straight days right around that 30 mark. Yesterday was -29.6. Today at -31. We had breached the 1,000 point level. Similar, we got above 850, but similar over here. We got above 1,000 in the early part of this year, going into that banking crisis. We were already pretty bearish when the banking issues occurred in March there. So the breadth had been very strong. It's looking less strong. We're still positive, barely. We're still positive. Same thing on that McClellan oscillator. But you notice we are well below the average there. And the other thing to kind of keep an eye on over the next day or two is whether we break the average here. Like when you break the average with a pretty decent bearish move, you break these averages, you start to turn south, especially from these very extreme levels on that one. Not as extreme here, but pretty strong levels here too. Once you break the average, that's when the weakness starts. And so that is something to keep an eye on because of how close we are to both of these averages, and the fact that we're already below this average, again, as a reflection of how extreme the breadth has been. And it was pretty strong. Like we had multiple days of this being above 400. That hasn't been the case over the past couple of years. So stronger breadth than what we've ever had in the past couple of years here. And again, remember, even during some of that run, the skew got very high. Got up above 160 at one point, but multiple touches above 150, and more than that above this 142.5 level, well below the average there, which also tends to lead to some weakness. If I were to look at the weekly version of the skew, again, we are below the weekly average, which is up at 139, and again, that tends to lead to some weakness when you get below the average for the skew, and obviously leads to strength when you get above the average for the skew up to the upside. Let's take a look at how the sectors performed here. So bear with me 1 second while I bring up the sector comparison chart. And again, we'll just look at today first. As you can see, the 3-month returns with real estate doing very well and energy not. Energy really declining today with the drop in commodities. But you can also see technology and discretionary are both big underperformers. Communication services kind of matching the market, but those two have been such big winners. They've been big underperformers. And if you look at the last 4 days that we've been bearish, they've just been hit hard. Both of those hit really hard. Communication services, again, kind of matching the market. But even your other cyclical areas are more economic growth sensitive, industrials, materials, they're struggling. Energy's been strong. It was much stronger before today, but still is outperforming. And then all your safety trades, including financials right now, which is not your typical safety trade, but it's doing pretty well as the inverted yield curve is less inverted. Remember, as the inverted yield curve starts to rally up a little bit, that tends to be bearish for equities. When you look at right here, let's look at the yield curve. Right around 40 basis points, right? So as it moves towards zero, and as low as it's been, as negative as it's been, and as long as it's been negative, as it moves up to above zero and towards 1%, especially the 3-month version with the 10-year, as that moves, this one here, as it moves closer towards, in this case, closer towards zero and towards this 1% level. Here's the 5 version. So if it ever gets back in this area, again, you saw what it did here in September into October when we had that rally up to 50 basis points, especially in the Russell 2000, got hammered. And here we are as low as we were back there. We're kind of set up for that kind of move, I don't know necessarily if that's the kind of move any of us really want to see right now. As one of the big reasons for the bullishness is the fact that these rate cuts were priced in, but now you can see we're down to just a week ago you were at about 87% odds, and that actually has been even higher than that. So when you look at the historical odds here, you can see we were at 1.91%, a little more than 90% odds of a rate cut in March. Now those odds, like I said, have been moving up pretty rapidly, are at 65%. And I think that eventually these, as well as the June odds, this would be the June odds for the two. You can see the one rate cut is pretty much 100%. But even two rate cuts in June, we're at 90% over here. And now it's less and less likely that we're going to get the two. You can see it's where it was there. Now today, the odds of two rate cuts, are pretty much 50-50, where it was just 90%. So I think all three of these contracts really are going to get to zero. I don't think we're going to get a rate cut in the first half of the year, and I think the markets aren't necessarily going to. Now again, that's probably a good thing for the markets, but with all the liquidity that's still available to the markets here from the overnight reverse repo, and then all the liquidity that's available to the markets from the TGA, right, from the Treasury General Account. You can see both of these are abnormally high, and as they fall back towards zero, where they normally are, that provides liquidity for the market. So I think that liquidity through the first half, so you got about a half a year's worth of liquidity there, is what people have been saying. That should keep us pretty okay. The markets might, have some pullbacks and some volatility because of the fact that this will move to zero. But again, the markets don't want rate cuts. Like, why do you think we had such a good, strong 2023? Because we never did get rate cuts. And we had 90% odds of rate cuts for 2023 baked in the cake at the end of 2022 and going into 2023 at the beginning of it. Even all the way up to May, we had 80% chance of two cuts by the end of 2023. That's as far as May. But those were priced out, and the market had a 23% gain, and now here we are again. So we don't want rate cuts. The markets, you want that inverted yield curve to stay inverted. We want the rate cuts to be pushed off, and the market can just continue to be strong as that can gets kicked down the road. And I think, again, part of the reason why is you saw what happened here in 2023. You had a big change in the, here, let's just go from, let's see, it would be from, let's change this to monthly. As you see this big drop in 2023 of this overnight reverse repo. I mean, we're talking over $1 trillion of liquidity added that offsets what's been taken out of the system here from the QT, right? So we haven't had $1 trillion taken out here. It's been more like around, we went from 8.5 to 7.7, so about 800 billion. So we added about $200-300 billion of liquidity to the system, mainly again from this, and we still have 600 and however many, where are we at right now? 665 billion left. And then, like I said, the Treasury account is at 758 billion. So lots of money in the system still. When they say cash on the sidelines, that's the most important cash on the sidelines that can really pump things into the system. Like I said, the first half of the year and stave off the rate cuts, provide a little volatility, but we'll still probably end up by that Fed meeting positive, right? With a positive gain for the year to date. It's that back half of the year when we don't have liquidity anymore. That's when I think the rate cuts start. The yield curve really starts to uninvert in earnest. Gets it back above zero by the end of the year on this, which, like I said, is not and historically been a bullish time for equities. All right, so for our trade idea of the day, I want to take a look at Twilio. Twilio, you can see, got a bull tag as well on its market forecast chart. It's intermediate line crossing slightly below market sentiment, but still in bullish territory, bearish short-term sentiment, the bull tag. So again, the idea being that we could get a nice little bounce here, a buy the dip type signal, or we can start a bearish move. And again, we'll know really quickly if we start a bearish move. And as we've talked about before, we're at least in our class portfolios at Market Scholars, we're hedged for the bearish moves. So we're okay. We're okay if it declines. But if we bounce back up, we can get a good reward to risk ratio. Especially on a move like this, you can see the weekly chart showing a transition. You can see it's not too bearish though. It's actually kind of a bearish candle, but not too strongly bearish. It's not, it's negative, but it's not strongly negative, and it's still above the orange line there for now at least. And you still got the golden cross that we just barely got. And when you look at the 3 green arrow version, of course we have 3 red arrows, but you got a lot of support below us, a huge volume node down below you. The MACD is only slightly negative. We're in bearish territory, but not at extreme lows, and we're only slightly in that bearish levels. If you look at the DMI, obviously we're not bullish there anymore either. And you do have the crossover, and we had such a strong DMI here, but we'll see if we're not below 20 on that positive indicator, so opportunity to buy the dip from that perspective. We talked about the RSI and the CCI. The CCI is a little low, but being below minus 200 is a little low there. I'd prefer us not to be, but you notice we're not below 40, so we're not quite getting the same confirmation of a strong bearish drop here and a move below 40. See over here, we got below minus 200. We were almost below 30 at that point. So an opportunity we might here have been pretty darn bearish. And we might get a little bit of a bounce off of this. You can see we're slightly below the blue line. We did lose the trend. It hit 0 on both of these. You still got a positive rate of change. And there's some risk to this filling in that gap. And like I said, we're hedged for that. And we'll know really quickly if it doesn't bounce, right? But the nice thing is being down here already and having the 3 red arrows, either will bounce up pretty well from here, or it will start a bearish decline. So what I would like to do here is say, okay, well, let's be a little aggressive on our setup, on our trade setup. Let's come out to February and let's do a bull call spread. So we'll buy that 75 and sell the 72.5. You can see what it does here. Let's see here. I can't see very well. No, that's the old position. So let's come over here to the analyze. Again, here it is. So sell the 75, buy the 72.5, mid-30s delta on that short call option. I get about a 2-to-1 reward to risk ratio. It doesn't have to go up immediately. I got some time here to work, some flexibility there to work with. And then, like I said, if it doesn't bounce up and it keeps dropping, then I take $100 or so loss, maybe a couple $100. For $1,000 of gain, we'll take that reward to risk ratio, especially considering that, again, we're at this level where either we're going to bounce up a lot or it's going to start a bearish decline. And if it starts a bearish decline, then we'll have some other opportunities for bearish trades in addition to the hedge position that we currently have. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going. Again, remember to subscribe to our YouTube channel. Hit that thumbs up icon, comment on the video. Join us at marketscholars.com. Subscribe to our site there. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday evening, everybody, and we'll see you all next time.